Benjamin Graham was a British-born American economist, professor and investor. He's known as the father of value investing and wrote some of the most widely used financial books. One of those is The Intelligent Investor. Not that we want to name drop, but pretty much the most successful investor of modern times, Warren Buffett, you know, the dude who's been in the top 10 richest people in the world for the last 20 years or so, was actually mentored by Benjamin Graham. In this video, we'll discuss some of the greatest lessons we can learn from Graham's book. Just to give you a little perspective, Warren Buffett referred to this as by far the best book in investing ever written. So stay tuned, because we'll discuss the 5 most important lessons you can also apply in your investing journey today. Now make sure to watch this video to the end so that you don't miss out on any of these vital lessons. Grab yourself your favourite drink, relax, and enjoy. Welcome to the Peak Performance Channel, the place where you come to be inspired to create a more prosperous future. The book talks about Mr. Market, and we are going to be referring to this guy. Lesson number 1. Let's meet Mr. Market. Imagine that you own part of a business which you paid $1,000 for. Mr. Market visits your home every day and tells you what he thinks your share of the business is worth. He might say it's worth a lot or a little, but it's important to remember that it's his opinion. And it's just that, an opinion. He might offer to buy your share or sell you an additional share, but it's important to remember that his opinion is not always right. For instance, back in March 2000, he estimated the value of your share to be $2,600. But only 1 year later, in March 2001, he thought it was worth $500, even though the company's income had increased by 50% and its profit had increased by 20%. So should you let this guy decide how much $1,000 of interest in your business is worth? Graham's core principle is that a stock is not just a number on a screen. It's an ownership interest in a company. The price of a stock can go up or down, but the underlying value of the company can be different. This is because Mr. Market isn't always rational. It's common for a home to be overpriced or underpriced when Mr. Market is too optimistic or pessimistic. Mr. Market can be fickle, so it's important to remember that you might not always get the price you want if you sell your home. However, for the investor who can stay calm during fluctuations, Mr. Market can provide opportunities to make money or not have to make a deal with him at all. If he offers you prices that are too high, you should be happy to sell to him and buy from him when he offers bargains. We need to remember that when Graham wrote this book, people were less bombarded with news forecasts, stock quotes and so on than we are today. In the 1970s, Mr. Market would arrive once a day and grow together with the morning newspaper. Today, he wants to do business with us every time we open our phone, which if you're anything like me is more than 100 times every day, with all of the information overload that we have. Just because Mr. Market visits you more often, it doesn't mean that you must trade with him any more frequently than people had to in the 1970s. If he doesn't present you with an offer that meets your standards, ignore him and move on with your day. Lesson number 2. How to invest as a defensive investor. There are 2 types of investors, those who are aggressive and those who are passive. A defensive investor should create a portfolio that includes a mix of stocks and bonds. For example, 50% of the portfolio could be made up of stocks and 50% of the portfolio could be made up of bonds. There's no one-size-fits-all answer to how you should divide your money between stocks and bonds. The amount you put into each category will depend on your life situation and the current difference in the average yield of stocks versus bonds. You'll want to restore this balance once or twice a year, so that if stocks suddenly make up 60% of your portfolio compared to only 40% in bonds, you sell stocks and buy bonds until that 50-50 balance is restored. Invest a fixed amount of money at regular intervals, for example, every time you get your salary. This is called dollar cost averaging. This will allow you to buy stocks and bonds at a fair price and will help you avoid buying when the market's high and selling when the market is low. For the stock component of the portfolio, you should look for the following key points. Checkpoint number 1. Don't be overexposed to one single company. Graham recommended 10 to 30 different companies. There are modern-day alternatives of index funds which allow you to balance risk. This is covered in a later section of the video. Checkpoint number 2. The defensive investor should be investing in larger companies, which Graham defined as generating more than $100 million in yearly sales. After inflation, this equals approximately to $700 million in today's money. Checkpoint number 3. Look for companies that are conservatively financed and have a current ratio of at least 200%, which means their current assets are at least twice as big as their current liabilities. Checkpoint 4. Dividends should have been paid to shareholders for at least the last 20 years. Lesson number 3. Investing as an aggressive investor. Being an aggressive investor isn't as easy as it sounds. An active investor is patient and disciplined, eager to learn and devotes a lot of time investing just to beat the market. You need to learn how to seek value and find opportunities. Unfortunately, not many investors are like this, so many fall victims to Mr.Market. Investing your money in companies that are priced too high can be costly as well. Remember, the profits of these companies are finite, so the price you should be willing to pay for a stock should be finite. That's what an intelligent investor would do. Price is an important consideration for an active investor. He knows that the market tends to overvalue and undervalue stocks, so he avoids these so-called growth stocks as much as possible. Investing in a company that is valued lower than its net working capital means you're paying nothing for all its fixed assets. Graham believes these types of companies are more profitable, but it's rare to find them now. Graham suggests that aggressive investors must also use other methods to find investments, just like the passive investor. He should aim for stocks that have a lower price trend, and he should also diversify his portfolio. The investor should also know how to study annual financial reports, because this can be useful in analysing companies. Now, before we move on to the next lesson, if you love content such as this, kindly give this video a like, subscribe to the channel and turn on the notification bell so that you'll know when we've posted new videos. Thanks so much. Now let's continue with the next lesson. Lesson number 4. Safety equals survival equals profitability. You're never going to get everything right all of the time, so plan for the fact that you might get it wrong sometimes and make sure that when, not if, when you're wrong, it's not a ruinous experience. The road to riches is paved by many, many tombstones of those who nearly got there except for this one extreme event. When the price of a company is only 2/3 of what it's worth, you may have found a company with a good margin of safety. A book has a formula that can help you figure this out. The growth rate should be equal to the expected yearly growth rate of earnings for the next 7 to 10 years. In general, no matter what the opportunity, don't overextend yourself. Anything can happen in life and you always want to have something in reserve. Do not be one of those tombstones. To do that, you just have to insist on the margin of safety in every investment you make. Remember, the price and value of the company are not always the same. Lesson number 5. Understand and balance your risk-reward ratio. Risk is always directly related to reward. If you're putting money into a government bond, then your money is relatively very safe as it's guaranteed by a government. and as a result of it being one of the safest investments, your rate of return will most likely be very low, typically 1 to 3% annually. On the other end of the spectrum, if you were to go and invest in penny stocks, well, you could double or even 10 times your money in a month, and you could also lose it all. Graham's guidance is that he firmly believes that the value of assets and price are actually disconnected. An investor must expect a return corresponding to the time and effort he's willing to put into investing. Ultimately, you need to understand this risk and balance your portfolio accordingly. So let's have a recap. Number 1, understand Mr. Market. Number 2, learn about defensive investing. Number 3, then there is aggressive investing. Number 4, safety and survival. And number 5, understand risk and reward. Well done for making it to the end of the video. Make sure you check out the video on the top habits of successful people. It's an absolute must-watch. What do you think of Graham's lessons? Do you think they are still applicable today, even though the book was first published decades ago? Let us know in the comment section below. We'd love to hear your thoughts on this. And with that, thank you very much for watching. And if you like what you watched, stay tuned for more videos, my financial buddies.